today in book club, we are going over Tax-Free Wealth, chapters 11 through 14. And our fearless leader, Natalie, is going to lead the conversation. Take it away, my friend.
Hey guys, so this next section, we're wrapping up part 1. And so we read chapters 11 through 14. And the first chapter was 11 on conquer your employment tax troll. I thought it was toll or rate, but no, troll. And so this was interesting because it dove a little bit deeper into what taxes are we paying. You know, it's not just your overall income taxes, but we're also looking at Social Security and Medicare. And so 2 key points I got out of this chapter was, you know, paying out on Social Security and Medicare is quite a bit. And then also when you're an entrepreneur and you're paying yourself a salary, your wage needs to be fair. So you can't underpay yourself, because then you're at risk of taking all your company's income as your personal income. And now you just went from 12% to, 40+%. And then, but on the flip side of not paying yourself too much also. So that way you're not overpaying those Social Security and Medicare pieces. What were your guys' thought on this, and any aha moments from, oh, that's a good point, or how can I apply this to my day-to-day?
Say that again. I'm sorry. I was reading a text message.
Oh my!
What was your question? I will admit it. Sorry, my
Wi-Fi went out, so I'm not gonna lie, I did miss it too.
You're okay. So I thought the interesting thing was, more. So one of the key points that he had said, or one of the little bubbles that was in here, was, the thought about paying your employees. And one of the things that you do to pay your employees is like you pay them this huge amount, and then they have to send about that much of it to the government, taxes, Social Security, Medicare, and they only take home the rest of it. So it's like, wow, if, too bad there wasn't a way where you can minimize this point, and then also minimize the whole pie, but they're still taking home the same amount. And I thought that was an interesting perspective of paying salaries, because you're already putting out so much money, and so much of it's going to the government, and you're wanting to take care of your employee, but you're really not, because they're still sending such a high piece of it to the government. And so that was one thing I thought was interesting about this chapter, but didn't know what your guys' thoughts were on how to preserve those extra taxes of Social Security or Medicare expenses when reviewing your expenses each month in taxes.
Well, for me, I alleviate them by only paying people under the age of 18.
Yep, strong move.
And then my employees are contract labor. And so, it's funny. So when I owned my old business, we actually hired everybody as a contract labor, because that was one of the strategies where me as an employer, I 1099'd everybody at the end of the year instead of W-2'd them.
Yeah.
And so I think that finding ways to eliminate those, it helps them as well, because if you do have a business where you can 1099 over W-2, then at that point they own a business.
Yeah.
And if they're smart with their taxes, that tax saving trickles down. Now, that's not a possibility for everybody right there. When I hire an assistant here in the office, I probably can't hire her as a 1099 or him as a 1099. And so we'll work with our tax people and see what our options are as far as trying to start alleviating some of that. Because I think there are things you can do where, maybe you give them different types of bonuses or pay them different ways and whatever. But again, you have to be careful, because even, I know when my ex-husband, he hates it when my child support's calculated, because part of his income are the prizes he wins. Like one year he won a trip that was like, I don't know, $2,500 was the value. But of course he had to pay the taxes on that as well.
Yep. Now that's interesting that you say that about the contract versus an employee, because I thought reading through this chapter that they almost applied that having an employee that pays into Social Security and Medicare as an employer, you can use more tax write-offs that way and save you more money. But I really appreciate what you said about having your employees be contractors, so they can become an entrepreneur and then apply these same tax strategies to their income.
I think This chapter kind of reminded me of what is it? Rich Dad was kind of talking about having control over the different types of income. It almost kind of emphasized that because essentially, as things are coming in on the E or even the S side, you're seeing a lot more taxes. And on the other side, it's like, sure, you're paying your taxes, but you're essentially paying them quarterly. And in some cases, that may not even be that much because you may be doing something like sending it to your kids or hiring individuals. And so another thing that it kind of reminded me of, I guess this is more of a comment, and maybe I'm telling on myself because I don't think you're supposed to do this, but like as an employee, you can kind of change your elections, right? And so what I used to do is I used to just tell folks, yeah, I have like 2, 3 kids and I'm married. So I would always put like 4 or 5 on it. But which I would never recommend, but I would always just keep up with, okay, well, this is what my tax liability should actually be at the end of the year. And then I would just pay that. and then like at the end of the year, I think one year it kind of caught me by surprise and I was like, oh, I didn't do that right. So I stopped doing it. But like you're not really supposed to. But that's kind of, again, it's like, sure, on the employee side, you could try and play around with that. But like I said, I don't think you're really supposed to. But when you're not working for someone, you already have that control over your income.
That's interesting. I put 0, claim nothing. Still, it's not fair. Craig, what are your thoughts?
As far as what you guys are just talking about, or the whole chapters that we read?
Just chapter 11 on
Oh,
your taxes, employment taxes.
I can't remember. I got lost a little bit in some of these chapters, and I felt like, wow, there was a lot of information between all the different types of taxes, and they all kind of started blending together. And I also apologize because I don't know which chapter I'm in. Other than I hit play, I just listen. And so I don't. Sometimes I'm like, what chapter are we in? Shit, I'm on like chapter 22. Oops, right? And so like a specific chapter, I don't necessarily remember. I was very interested in a lot of the different buckets of taxes that, and again, I'm the same way. Now, I don't really deal with a lot of other taxes other than employment taxes. But between sales taxes and use taxes and all these other things and kind of the offsets of here and there, I got a little bit lost, I got to tell you. I feel like I don't know a lot, and I'm glad I'm not a CPA, though. But I mean, and I definitely don't know enough. Even like I feel like I'm kind of a shitty attorney at sometimes at some of this stuff of the structuring and dealing with different types of. And I'm getting there. Peeling off layers of tax liability through different things, which is why I was very interested in it. Where okay, well you can peel off your employment taxes by doing blah 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 blah. Then you can peel off your sales tax by doing this, and then you can peel off some of your use taxes by doing all this stuff. And there's so many different strategies that, man, having a good CPA firm is super important apparently.
Right, a good tax advisor for sure.
Because I got the first up until this past time, I was kind of following along. I tracked very well and made a lot of point. I feel like we got a little bit in the tax weeds on these chapters, and it was definitely over my head. Now I tried to pay attention to it and follow it all, but what the fuck, I'm lost. I don't. He's losing me. Better for worse.
I would agree too. I think a lot of these chapters is like, okay, when I'm ready to start figuring out how to reduce in my, especially estate planning, which was chapter 13, I'm gonna have to go back and read this chapter and make sure I check all those boxes and dive into those other topics more deeper.
Yeah, and I'm trying to remember what his specific strategies on the employment side. I some of it I got, and I do that as well, where I pay myself, and I think we both pay ourselves very little W-2, right? To try, because the Social Security and employment taxes are not paid against the dividends, right? And so I've kind of that strategy I've heard of for a long time, and I kind of keep that where again, I've always keep my W-2 in a low thing. Now buying a house makes it a little bit tough because, you know, your W-2, you're making 10 grand a year, and, you know, and that's what they want to see. And without going into the full records anyway, yeah, I think yeah, that's a very important piece of the puzzle, but there's a lot more to it. And I still, you know, the kids and the using like that, I still don't. He touches on some really interesting key points, and you always probably need a whole book on each chapter because they are very like, oh wow, so interesting, and then he's on the next topic. Like, well, how do I do it?
You're missing that piece.
Right. So there's a lot of like, oh, that sounds awesome, and then he's on to the next topic. I'm like, oh, okay. Sounds good. And yeah, to my point at the beginning is we got a bad CPA because again, it's not I'm an attorney, right? You're realtors, and you guys are we're all entrepreneurs and business owners. None of us, I guess, except for David, is really on the financial side in the CPA stuff. But I don't think you're not a CPA. You're more of an accountant. Is that how would you describe your job?
Well, I am a CPA. I work damn hard for that certification.
Oh, so you are okay. So you are an official CPA. Okay, I didn't know that. I know you do numbers and stuff like that. I do your taxes, but you don't have to be a CPA for that.
You can be an enrolled agent. You could be a TPN. There's a bunch of different things.
You're officially a CPA. Oh, you go.
One day, David will have this all worked out, and we'll all be hiring him. I've already told him that.
Well, so I think the next chapter kind of goes into like the different types of taxes. And initially, that was actually what kind of shied me away from specializing in tax, because it does get really into the weeds. So like, for instance, when he talks about property,
CPA specializes in tax?
So there's 4 different things that CPAs specialize in. That's a huge misconception.
Okay.
Yeah, so there's CPAs that are like attorney adjacent on the business side. There are CPAs that are tax and regulation specific. Then there are CPAs that are actually on the business valuation side. And then there are just financial reporting gurus. So I was always just a financial reporting and audit person. And so then I kind of started learning about tax. So, yep. But it's essentially you just kind of update your knowledge because they teach you everything on the exam.
Gotcha.
Yeah, but you're right, David, where the next chapter 12 was about property sales and value add sales taxes. And you know, charging sales tax, you know, make sure that you cover that if you owe it to your customers. Otherwise, you're gonna have to back pay it. That's right. Business is out of business.
That one's scary. And a lot of accountants, I don't think really realize the gravity of it. And I'm glad he kind of pointed it out the way he did, because essentially, worst case scenario, you don't charge sales tax. That could be $30,000 in a year. The IRS or the state government's going to come to you and be like, hey, you owe us this much taxes. And there's nothing you can do about it other than this is how I'm going to pay you. You know, because you can't go back to the customer and say, hey, you know, I didn't charge you that 7.5% or 8% sales tax. They're going to be like, screw you.
Yeah, that's a common question that I've actually always heard. I never really knew the answer. I just kind of kicked the can. You need to talk to your CPA about that one. Because I've set up some clients that are doing internet businesses and things like that. And then some of them are doing it themselves, and they're like, well, when do I still collect sales tax? When I not collect sales tax? Well, now I have a great answer. Always.
Unless
always
you have
collect it. It doesn't matter. They pay it regardless. And people aren't necessarily shopping. I think for a little bit, people shopped on Amazon because they can get away without the sales tax. But now Amazon charges it for everybody also, because eventually, I know that every state basically started saying, well, yeah, facilities here, enough's enough. You need to start paying the taxes.
Right.
And so there's a little bit of a caveat of a time period when internet sales really was exploding, i.e. Amazon and some of these big people. But for the smaller shops, before now people don't even sell themselves. They create a store on Amazon, right? They use Amazon backbone and stuff like that. No one sells direct to their store. They put their stuff on Amazon. When you buy it, you're buying it from the local store. And some of them, like I got probably a client a month that comes in that are buying turnkey Amazon shops, right? So basically they're coming in, Amazon's like, and the company that set up everything. Because that's why if you go like, wait a second, why are there 35 sellers selling the same thing? It's because there's a chop shop that has been putting to these cookie cutter businesses, and they're all selling the same product, and it's a numbers game. All right, listen, there's a million people that are buying the same item. Hopefully 1% buys from you and 1% buys, and it's all the same product and all the same seller, and we're actually the same backbone, but we're just going to give you your own separate name. And so it's a little bit easier now at this point because they just hop on Amazon, and Amazon handles all that stuff at this point when you're an Amazon store, and you say, yes, do what you got to do and send me the profits.
Exactly.
But it was definitely a question that came up a lot, when I first started my practice and it was like, yeah, just collect. Now I have a great answer. To collect from everybody because that's what everybody should be paying. It's definitely new to me in that sense, and because I definitely thought there was a period of time that you can kind of jurisdictional shop for shopping, if you will, from a sales tax perspective.
Right. It's almost one of those questionnaires. You're starting a new business. How much in taxes do you need to charge? It's not even a question if you have to pay them or not.
Yes. Sorry.
Okay. So that was, kind of a dry chapter. So if you guys don't mind, we'll jump into chapter 13. And we'll talk about estate planning and is good planning is the chapter. And this one was a big one. And what's been really neat in my own life is reading this book and then looking at my parents or my siblings and all their careers and entrepreneurships and seeing these rules and techniques applied to their businesses, and even asking them questions about the way that they're running their businesses, and be like, oh, did you think of this, or are you doing that? And so if nothing else, it's making me more knowledgeable when I'm having those discussions. But that's been pretty exciting, and to also seeing like my own parents putting their stuff into trust and establishing that. It's like, oh, that's why they did that, or even thinking, oh crap, they should have done this differently, or something like that. But the 3 key points is placing assets in trust, create a will, and avoiding estate tax. So definitely, Craig, I saw this being your chapter of the book of.
Well, yeah, I mean, it was definitely, again, half my day is spent doing that type of stuff, other than the tax planning. In the past, again, beating a dead horse as far as where I might want to take my practice when it comes to some of the tax issues and estate planning with tax issues, things along that nature. But because I've always been so uneducated on the whole thing, it's always been, don't talk to me about taxes. I'm not a CPA, I'm not a tax attorney. Go talk to those people and I'll help you with avoiding probate. That was the estate planning that I did, and the use of the trust for that is control and avoiding probate. Now I'm getting a little bit better, a little bit more comfortable having some conversations with it. And now there's definitely when estate tax issues and potentially step up and basis issues when it comes to estate planning. I have a decent okay knowledge on it. Subject to it's a moving target with estate taxes. Right now, it's about $12 million, which is going to have a sunset in 2026 and drop back down to about $7 million per person. So, but there's so few people, at least that come across my desk, like, oh, okay, I need to worry about, I don't want to pay estate taxes. Great, you got $20 million? Like, no. I'm like, do you have 5 million? No. We got about 100K. All right, and we're worried about estate taxes. Why? Not to be condescending or anything, right? It is definitely, everybody talks about it, but it really only affects less than 1% of the population. And it's definitely the 1% is sure where it's doing it. But that is, it's a really, the intent, it's a moving target to the extent that it's at Congress's whims. Back in the day, some of these trusts that I see that come in are very, very complex because they were designed in like the 80s when you only had $1 million. Well, $1 million, people had a $500,000 or $1 million life insurance policy. Now you're over the limit already, right? So you had to do tax planning right away. Nowadays, it's so high that very few people need to worry about estate tax issues. Now, and then also step up and basis issues. I think where he was talking about, or I don't know if I was reading somewhere, but with trusts, irrevocable trusts lose the step up in basis. Revocable trusts keep the step up in basis. So, and I think that was a new law that came with the 2016 tax cut. So now when we're talking about a step up in basis issues, because that's another common issue, is okay, my parents bought this house in Atlanta in 1972 for 50 grand, right? Well, lo and behold, 30 years later, 40 years later, that 50 grand house is now worth $600,000, right? And then that person is still living there. They're going to die. They're going to give it to their kids, and their kids are like, well, I don't pay capital gains on this thing.
No.
Well, you don't have to, as long as it's a revocable trust. Now, a revocable trust is advantage for avoiding probate, but it doesn't have a lot of other tax advantages, some of the irrevocable stuff that you're dealing with, and asset protection wise, right? So asset protection wise requires irrevocable, but then you lose that stuff up in basis nowadays. So now it's like a whole combination that I'm not going to deal with. It's very, I don't know. I don't even know what to talk about the chapter anymore.
Well, it's interesting because it's like you almost have to assess what's going on in that person's scenario and then decide what strategies or steps to take. And it seems like you're choosing your path, and it could be very different.
For sure,
Well,
depending on whether you're doing legacy, short-term, long-term, capital gains issues. Because again, which taxes are we talking about that we're trying to avoid? Income tax, capital gains, estate taxes, everything. There's so many different taxes that not everything. There's no one panacea. Is that the right word? To cover everything.
What were you gonna say, Laura?
I was just gonna say that's why having a team, and I think his point in a lot of these chapters where you revisit quarterly with that team to make sure that you're going down the right path. Because I think it's chapter 14 he starts talking about like not only tax protection but asset protection. And so I think chapter 13 kind of leads into that. But I mean, I know I don't want to leave my kids $1 million in taxes with capital gains when we die. And so I think that looking at where we are today and then where we are again at the end of the year and then at the end of 2024 and so on helps to make those adjustments. It's not, when you're investing in the stock market, you hire somebody, whether it's Edward Jones or whoever, and they're supposed to look at that quarterly, monthly, and make those adjustments. I think a lot of times when it comes to our salaries and our other assets that, especially real estate, we set it and forget it. And so I think that as your needs and your desires and your whatever changes, then at that point, God forbid you have stuff in your kids' names and you're using that as a, tax protection. What happens if that child passes away? What happens if that child gets married? There's a lot of different things that come into play. So I think that looking at it with your professionals is so important.
Yep. We're developing quite the great team here. We got a CPA, a lawyer, real estate agents.
Yeah.
What are we missing? We need recruit. Okay. Well, and then chapter 14 was on reducing your taxes in other locations. So that was, having taxes in multiple states or countries. I thought it was interesting how countries can reciprocate that. If you pay income taxes in one country, you don't need to pay it in your other country. Really interesting. I thought about having your multiple states of, finding that state that has such low taxes and figure out a way of how to make the majority of business come from that state while you're still located in your state. And that was an interesting perspective. And I don't know, did that get any of your guys' wheels spinning of where you're going to set up your next location?
So when I was reading through this chapter, it actually kind of helped me. So I remember from school where I just remember, sure, there's a bunch of different types of taxes, but as long as you kind of record everything correctly, generally when you go to do your income taxes, a lot of the times you can use those as deductions. So it's like he essentially kind of went into a little bit more detail, I feel like, and it was just kind of interesting hearing it.
Oh, good.
Yeah, this is definitely one of the chapters I got lost in, for sure. I found it very interesting, and again, lost in it in the sense of I would never have thought that having tax liabilities in multiple jurisdictions will end up in a lower tax bracket, lower tax situation. I was like, what? Like I was like, no, why would you want to deal with two states? That's two tax returns. Everything's more expensive. You're paying, and not only is it less expensive according to the book, you're paying less in taxes, which I don't know how that works. Again, that's why, my opinion is, let's hire somebody who knows what they're doing, because I am so lost. I would never have thought that having at least two. Now, maybe there's a situation that you got to go over the board. Okay, 7 states, now you're kind of losing money, right? But to say that you should have at least 2, oh shit, I fucked that one up. I'm only 1.
I thought the same thing. We're only in one and we have multiple businesses. Should our payroll company be in Delaware?
I don't know. I mean, should we have, for us, should we have done the Lerman Holdings one? Should that have been a Louisiana entity? I don't know. Now we're paying, but is it what tax as well? Again, is it, income tax that you're dealing with? Is it with the sales tax issues that you need to be more than one state just for sales tax? Well, I don't collect sales tax with my services. Neither do you. I think in real estate, and David, as you professional, I don't think you do any sales tax either. So none of us really have sales tax in our business. If I don't know if that only had to deal with the sales tax issues as opposed to just tax in general issues.
No, I
So
think they were talking about income tax too in that chapter.
yeah, from my understanding, it's both. It's going to be sales tax. The sales tax is at the state level, and then it's also going to be your state income taxes.
Okay. Well, and I think just with every state, there's always pros and cons to them. So even though there might be this benefit, you have to offset with that other expense that you might accrue. I thought for sure you guys were looking for your next office in Florida.
Oh, listen, that's already started, my friend.
I'm not quite sure about Florida anymore, babe. I'm a little bit nervous. Well, there's no insurance left in Florida.
Oh, they stopped doing insurance?
All the insurance companies are leaving.
Oh no.
There's like three
big, forget Florida. We're done with
State Farm exited Florida. You can't get a State Farm insurance policy. There's like two. So I think it's gonna be, they're talking about a major housing hit to Florida because there's gonna be no one's gonna be able to afford the insurance anymore. There's gonna be like two companies left, and there's gonna be talking about hurricane for $6,000 a year. It's gonna be like 20 grand a year for insurance because it's almost becoming an uninsurable state.
Well, that's like Louisiana. We ran into the same thing when we bought the house. Finding renter's insurance made the investment not worth owning because the insurance was so expensive that my insurance person actually had me put the tenants on as just a person living there and not as a tenant.
Right.
So it's still got secondary home insurance.
Wow. Yep. And that's not even a tax. So a whole nother thing you have to consider.
It is a tax, but yeah.
Okay.
Well, I'm interested to see what happens to the housing prices in Florida.
They're predicting something. I mean, who knows? I mean, they, who they really are and what they's actually going to do.
I think you can buy tax liens virtually in Florida. That is the move.
Noted.
I guess it's be a cash state. You can only buy property in Florida with cash because you can't get an insurance, so you can't get a loan because the loan's got to have property insurance.
Oh no, that's interesting.
Mm-hmm.
Last time I couldn't get insurance, we had to walk away.
You gotta buy cash. Well, if you buy cash and you own the property, then it's your loss, right? You don't need to have insurance for everybody else. You need insurance for the lender.
Mm-hmm.
Good practice to have insurance for yourself, but legally.
Well, great. All right. Well, that wraps up part one. And so next week, so we got 2 more meetings on this book. Part 2 will be your tax strategy for tax-free wealth. We'll be reading chapters 15 through 19. And then the following week, we'll finish it off from chapter 20 to the end. So if you guys want to start planning and then start thinking too about our next book and who will get to choose that and announce it, I think August 8th will be the date.
Perfect. David, you did the last book, right?
Yes, and my birthday is August 5th. Don't forget it.
Done. My birthday's the month of September. Don't forget it.
Oh, it's September. It's right after.
Well, let's see how big we do August 5th.
But it's the whole month, just so you know. I have a birthday month, not a birthday day. Yes. So I think Steve would have actually been the next person to do the book. So that would leave either me or Craig. If you want me to do the next one, I'll do the next one, and then you can do the next one, or you can do the next one and I can do the next one.
Did Steve back out?
Oh, you missed that. Yeah. Steve ditched us.
What?
R.I.P. Steve. For now, hopefully he comes back.
Yeah, hopefully he comes back. He feels like he needs to spend more time in production in his business.
I'm rooting on you, Steve. Produce your way back to book club.
Fair enough.
Yes.
Okay. Well,
Yes. So
then-
Craig and I will make a decision on the books, and then we'll one of us will lead the next one. But yes, we will have a book and we will talk about that offline.
Bet.
Sounds good. All right. So next Tuesday, chapter 15 through 19. And we're into part 2, guys. Halfway done.